As of Saturday, January 24th, 2026 at 9:52 p.m. EST, the market is closed for the weekend. Bitfarms Ltd, trading under the ticker BITF, ended the regular Friday session at a live price of $2.74, marking a solid 3.01% gain for the day. While the headline figure looks like a standard recovery, the underlying mechanics of the trade tell a much more aggressive story. Throughout the session, the stock hit an intraday high of $2.87 before pulling back slightly. This price action isn't just a random fluctuation, it's a reflection of a massive tug-of-war between high-frequency retail traders and institutional accumulation that's been building up over the last few weeks. If you look at the volume, we saw over 36 million shares change hands on Friday alone, which is a significant chunk of liquidity moving through the system. Most people looking at Bitfarms right now think they're just betting on a BTC proxy. They see the BTC price move up, they expect BITF to follow, and they buy in. But the reality that most people are missing is that Bitfarms is quietly pivoting into a high-performance computing powerhouse. They aren't just a mining shop anymore. They've been aggressively moving their operations toward AI data center services, which is a completely different business model with different margin profiles. While the average investor is staring at the BTC charts on their phone, the smart money is looking at the company's recent exit from Latin America, specifically the sale of their Paso Pay site for $30 million and how that cash is being recycled into US-based infrastructure. They're repositioning themselves to be the backbone of the next wave of compute, and that's an angle that hasn't been fully baked into the current stock price of $2.74. When you look at the recent stock movement, it's clear we're in a high-tension zone. We had a sharp 10% drop just a few days ago on January 20th, which spooked a lot of the weak hands. But since then, we've seen a steady climb back up. This kind of volatility is exactly why people use tools like the Robinhood app or interactive brokers to try and catch the swings. On the institutional side, we're seeing a lot more interest in the convertible note offerings. In fact, management recently noted that 100% of the institutional investors they approached participated in their latest capital raise. That is a massive vote of confidence that you don't usually see in a penny-adjacent crypto stock. It tells us that the big boys are looking at the long-term infrastructure value, not just the daily hash rate. Speaking of institutional activity, let's talk about the pressure from sector momentum. The entire digital asset space has been dealing with legislative delays and regulatory noise, but Bitfarms has been focusing on what they can control, their efficiency. They've been upgrading their fleet to improve their hash rate capacity while simultaneously lowering electricity costs. This is the reality part of the equation that beats expectations. If they can get their direct cost per Bitcoin down while the market price stays stable or climbs, their EBITDA expansion is going to be massive. Right now, analysts are predicting they could hit profitability within the next couple of years, with some even looking at 2026 as the breakout year for their EPS. If you're doing your own self-investing or looking for investment help on various investing sites, you've probably noticed that the narrative around Bitfarms is shifting. It's no longer about how many Bitcoin they can mine in a month, it's about how many megawatts they have under management and how much of that can be leased out for AI workloads. They recently announced plans to convert their Washington site to support advanced liquid cooling. This is a technical move that is designed to attract high-tier AI contracts. This isn't something a simple miner does. This is a strategic play to diversify revenue streams so they aren't 100% dependent on the 4-year halving cycle of Bitcoin. Now, I want to hear from you. Comment below how many shares of Bitfarms you currently hold and whether you're in this for the Bitcoin exposure or the AI infrastructure pivot. It's interesting to see how the community is split on this one. Let's look at the business model for a second because it's the foundation of why the stock is behaving this way. Bitfarms was founded back in 2017, and for a long time it was just a Canadian-focused mining operation. But look at where they are now. They've got over 13 operational data centers and are reaching towards an energized capacity of nearly 500 megawatts. They're re-domiciling to the United States, which is a huge move for their valuation. Being a U.S.-based company opens them up to a much wider pool of institutional capital and could eventually lead to inclusion in major ETFs and indices. This is the kind of move that creates long-term floor support for a stock. In terms of the future outlook, there are a few catalysts we need to keep an eye on. First, there's the integration of their Stronghold acquisition. If they can successfully merge these operations and streamline the power costs, the synergies will be a major driver for the stock in the back half of 2026. Second, we have to look at the macro environment. If the Fed continues to hold rates or even look at cuts, the risk-on appetite for stocks like BITF, Tesla stock, or Nvidia stock is going to increase. Investors who are used to the volatility of Robinhood investments or SoFi active investing are already positioned for this, but we might see a more conservative crowd from Fidelity Brokerage or Schwab Intelligent portfolios start to nibble at these levels if the AI narrative gains more traction. However, we can't ignore the risks. The reality is that Bitfarms still has a significant amount of debt, and they've been using an at-the-market program to raise capital, which dilutes existing shareholders. They've issued over 160 million shares recently to fund their growth. For someone sitting with a self-directed brokerage account, that dilution is the reality that often clashes with the expectation of a moonshot. You have to ask yourself if the infrastructure they're building is worth the share count increase. So far, the market seems to think so, as the stock has held its ground above the $2.50 support level fairly well. If you're using a platform like SoFi Invest or checking your Interactive Brokers account daily, you know that timing these entries is everything. The stock has a 52-week range between 67 cents and $6.20. We are currently sitting towards the lower middle of that range. If the AI data center pivot starts showing real revenue in the quarterly reports, that $6.60 high isn't just a distant memory, it becomes a realistic target. But if Bitcoin hits a snag, or if the AI hype cools off before they can get their sites converted, we could see a retest of those lower levels. The expectation is that Bitfarms is a high beta BTC play. The reality is that they are transforming into an energy infrastructure company that happens to mine Bitcoin. This distinction is what will separate the winners from the losers in this sector over the next 18 months. They have over $800 million in liquidity, including a healthy stack of Bitcoin and cash, which gives them the runway to make these big moves without constantly looking over their shoulder at the daily price of crypto. In summary, Bitfarms is in a period of intense transition. The Friday close at $2.74 showed that there's still buying interest even after the volatility earlier in the week. We've seen a clear contrast between the retail expectation of simple mining and the institutional reality of a massive infrastructure build-out. The sale of international assets and the focus on U.S. power capacity are the real stories here. Whether you're using Fidelity Wealth Management or just starting out with Robinhood fractional shares, this is a stock that requires you to look past the ticker symbol and into the actual megawatts they are controlling. The tension between their high debt and dilution and their massive growth potential is what makes this a compelling watch. We'll be keeping a close eye on their next earnings report to see if the non-mining revenue is actually starting to hit the bottom line. Until then, the stock remains a high-stakes play on the future of energy and compute.